how long can you stay lucky? How long can you keep running the table and keep hitting these, keep rolling these sevens or whatever?
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. Darren, today we're going to talk about what happens when things are going really well with your trading. So what were your thoughts on this?
Yeah, well, I've heard quite a few really experienced traders with a long track record and a lot of experience in trading say that when one of the key things in trading is to be able to kind of seize the moment and know when the opportunity is really good and go all in, and a bit like a poker player would do, I suppose. And I've been thinking about this personally. My last 3 months, my trading's been going very well, and the temptation for me is, I'm kind of in a zone at the moment. I can't put one reason why it's going particularly well. It's a combination of things: the right sort of market conditions, I'm making good decisions, maybe a bit of luck's playing my way as well, and maybe my strategy right at this moment is particularly suited to the market conditions. And the question is, when this happens, should we, in that moment, should we go all in and up our risk and try and capitalize on the current conditions, or is the sensible thing to do to just kind of stick to your plan, your usual money management and risk strategy, and stay consistent? Yeah,
it's a fair question, and it's kind of related to the question of, when you have a drawdown, do you reduce your position size, or do you try and get it all back by, during a drawdown, you up your position size? It's kind of the inverse of that, isn't it?
Yeah, and I've heard many traders say that if they're starting to lose money, they keep reducing their position size until it comes back. But it does kind of beg the question. Well, I mean, what it comes down to, I think a lot is why you believe that you're winning. And I mean, if you believe that it's really more down to your performance and the fact that you're just kind of in the zone and you're reading the market particularly well, or your strategy well, and there's kind of a gut thing going on there, sort of subconscious pattern recognition, and you're just kind of in tune with your trading strategy, if you like, then if that's true, then maybe you should make the most of the moment and increase your risk. And the obvious thing to do would be to do that, but perhaps not do it so aggressively that it could all blow up in your face.
Yeah, I don't think that it's a good idea. I mean, personally, I think that essentially any sort of win streak or losing streak you have is a function of your win rate. So if you've got a higher win rate, you're more likely to have some really nice win streaks. If you've got a lower win rate, you're more likely to have some pretty painful losing streaks. And two traders I know, one trader who spends a lot of his time doing technical analysis on his traders, so on his group of traders that trade for him, he would plot the 10 and the 20 moving average. So this is sort of, where are you going as a trader? What's happening with your results, basically? And what he found is, as soon as the 20 moving average, so to speak, crossed the 10, it was time to sell the trader, get out. So this trader was due for some sort of reduced performance. And our friend James Kensington, who of course is a superstar in our forum, he's got a lot of people asking him questions in the forum, and he's been really helpful with his time. But what he does with his traders, he knows that 3 months into it, it's interesting that you say 3 months, because he knows that 3 months into it, he expects his traders to have a bit of a fall back down to earth, and that's when they're off. So they only work for 3 months for him, and then they're done. So I think that two people that have looked at this quite closely have basically come to the same conclusion, which is, once you've had a hot streak and you're feeling really, really good about yourself, that's probably the best time to pull back. so I'm gonna go with the data on this one. What are your thoughts? Well, I mean, I know, like, here's the thing: you can make a lot of money. It's kind of like when there's a bubble in the market. It's sort of like that. Like, if a bubble is happening in the market, you can make a lot of money by trend following that bubble. But boy, you better get out at the right time, because if you don't, when it pops, it's like the game of musical chairs. Everything's all over now. And if you can't find a chair, you're done. So that's the way I look at it. It's kind of like a reversion to the mean sort of thing. That's how I look at it.
Yeah, I probably feel that agreeing with you is the right thing to do here personally. Because I know long term that if I kind of stay doing my normal thing, then I'll always be right. Except there's some some really bizarre events and it goes horribly wrong. But I feel fairly confident that if I stay within my normal kind of risk and trading, that long term I'll be all right. So I think really if I did do it personally, it'd be more a case of greed and ego than anything. But I just thought it was a kind of interesting thing, and I think for some traders, it might suit them, especially if you're fairly discretionary on your entries. I think at some point after a long period of time, there's got to be, you're going to get to the stage where there's going to be a lot of trades you take, and then there's going to be trades where you just know in your gut that this is a great setup, and then even after you enter, perhaps it feels even better then, and you should add to your trade. And I suppose that's kind of would be a style of trading in itself, rather than something that you would just kind of decide to do because you'd had a good run. So I'm going to agree with you here, and I'm just going to stay in my normal risk thresholds and just continue doing what I've always been doing. Interestingly, though, I mean, August I only broke even, so maybe you're right. Maybe I've just come to the tail of my lucky streak.
Right. Well, it's interesting the things you bring up, because you can be right. So George Soros talks about this a lot, where when you're right, that's the time when you're absolutely 100% convinced that you're right. That's when you need to be a pig. And you've seen the movie The Big Short, right? Well, I know you've seen that movie.
Yeah, great movie. Yeah. Yeah,
it's a great movie, and these guys are right. But how long can you be right and lose money, right? So the market can keep going longer against you, even though ultimately you're going to be right. I mean, the great thing about being a bear, a strong bear, or even a unapologetic bull, is that eventually you're going to be right. eventually the market's going to come around and agree with you. The issue is how long before you go bankrupt, and if you go really hard on your position, like some of these people do. So, to me, that's the real thing here, and it's related to what you're talking about, because how long can you stay lucky? How long can you keep running the table and keep hitting these, keep rolling these sevens or whatever? I don't even know. Do you play craps? Have you ever played craps? I've never played craps.
No, I never played it.
Okay, well, that's a bad analogy then for two guys that have never played craps. But you know what I mean? But so how long can you keep rolling it? The other thing that was interesting to me, Darren, and I like to dig into this a little bit, which was what you were talking about earlier. You said, because I find this idea fascinating, and I think a lot about it, which is, you said something like, unless the market's doing something highly unusual or bizarre or acting strange. So, like, how do you know when that's happening? Because that's kind of related to what we're talking about here, where you're having a really good streak and you're doing really well with your trading. So the other side of the coin is, what if things are going really bad? How do you pinpoint that as market related?
Well, usually I just feel, and there's no avoiding it before. There's never an opportunity to avoid it before it happens. So, at some point you're going to feel that pain of an extended losing period. I had one quite recently, actually, with coming up to the Brexit vote in the UK. because I was trading mainly the pound dollar. It was like an extended period where it was just very difficult, and even there was just no breaks at all, and at some point you just kind of have to make a discretionary decision. Okay, this isn't working, I need to do something. And for me, I just moved to different instruments, and I moved up a time frame, and obviously that's not going to work for that, works for my strategy. My strategy is easy to do that. And obviously, if you trade a different way, there would have been, a different answer to the problem. But I think you've got to listen to your gut every now and then. And the real skill is learning, when is it a particularly unusual market or a particularly bad market, and when is it just the normal course of your trading strategy. So you don't want to every time you have a losing day, if you change, then that's probably going to be unproductive. But you need kind of some sort of mental switch that says, this isn't usual, this isn't normal, maybe I should do something, reduce my risk, stop trading, have a break, etc., etc. And I think you can only really get to that by time and experience. And when they say it takes 10,000 hours to learn to be a trader, I think it probably takes 10,000 hours to learn to trade, and then maybe another 10,000 to learn to sort of listen to your feelings and make good judgment calls on what your gut's telling you.
Yeah, absolutely. I think that we're definitely not set up to know that. That's something that you can possibly gain with experience, but people aren't set up to know when that's going on. And I don't even know if, I think about this a lot. How is it possible that the markets are doing something unusual, or is it just kind of normal for the markets to sometimes do these weird things? In other words, so like you'll hear people say things like, oh, well, the markets are so much more volatile now than they were in the 1980s, or, oh, the futures markets have changed with automated trading and all the algorithms and blah, blah, blah. People are saying stuff like this. And so my question is that really true? Sure, you can have a look at the charts and go, yeah, look at these candles are much wider and this and that. But I just wonder if it's not something that we try and, because we're so good at seeing patterns, right? I trade with patterns. We're so good at seeing these things and putting them into boxes and categorizing them and making these mental shortcuts. Our whole mindset is now I spend a lot of time thinking about this related to trading. Everything we do, really, the way that we think is made to make it easier on us, because we spend so much of our energy sending that to our brain. Our brain takes up 20% of what we eat is burned off in our brain. So we've got to have these shortcuts. So I guess I just wonder, is it really the case that we can stand back and look at something that happened in the markets or otherwise and say, yeah, okay, now that was weird? Or are we just making up a story? Are we just making up a story after the fact and saying, this gets back to the whole idea that Taleb talks a lot about with the black swan, and how we often will have these problems or these major catastrophes and things that come straight out of left field, and we explain them away, and then we create a story around it and say, well, this is what happened, and I don't know, is that really true? So I don't know, it's tough for me to try and get my head around this, and the best thing I can come up with in terms of how do you counteract this is to try and come up with very, very simple rules in your trading, because the fewer degrees of freedom you have, the less likely that you're curve fitting. And so curve fitting is really the monster here. If the markets do really change, and then if you overfit your system to past data, then you will see it fall apart in the future. Now, if you use really simple, robust instruments, then that's unlikely to happen. And that's why if you carry a hammer around, you can do a whole lot of things with that hammer. You can bash things, you can break things, you can pry things open, you can punch a nail into some wood. You can do a lot of things with a hammer. But if you carry a USB cable around, there's not a lot you can do with it. You know what I mean? So yeah, I mean, that's the way I look at it, and it's just fascinating to me as traders how we view this idea that, oh, okay, the markets have changed now, and you know, I don't know. I mean, the only solution I can come up with is we've got to decide we're going to trade a very simple way, and if we trade in a very simple way with very few rules, then it's most likely that those rules will hold up in different, quote, market conditions as the markets, quote, change, you know, that sort of thing.
Yeah, I've got to agree with you 100% there, Walter. And I think your main trading idea has to be something really simple. And, you know, I tried in the sort of development of how I trade, I tried to sort of say, you know, what is always true, not these kind of weird anomalies like, you know, every Monday after a big move Friday, if the range was less than 120, then we should get... Do you know what I mean? If you work on these kind of weird anomalies, they're unlikely to be robust in the long term. So I want to say, you know, what's always true, what's always going to give me an opportunity, and then I'm going to build my strategy to try and make the most of those opportunities. And for me, it's that the one thing that remains true always is that markets do this random walk levy flight where, you know, we have consolidation and then price moves, and we have consolidation and price moves. And so that was the pattern I looked to build a system to trade, rather than just kind of weird anomalies that, you know, very rarely stand the test of time. And this is why, you know, when you listen to people who have worked or work in, you know, these places where they use very complex algos, they've got, you know, loads of computing power and, you know, the smartest people in the world, and they're constantly revising their data because they know that if you find, you know, one little edge and rely on that repeating and don't continue to recalculate your data, then it's not going to remain. It's very unlikely to remain. And, you know, obviously as retail traders, that's the worst route for us to go down, because, you know, we're unlikely to have the one trader I was listening to said that they spent $3 million developing their system and their algo. You know, we haven't, very, very few of us have got that sort of money and time and expertise to throw at it. So, you know, why try and compete with them? Why, you know, you have to try and come at it from a different angle, and that's what I've tried to do.
Yeah, but see, here's the thing. This is what some traders out there are thinking right now. They're thinking, well, I've got to do what they're doing because that's what makes money. How do you fight that? Because there's that feeling that some traders are going to say that. They're going to go, well, the hedge funds don't trade the daily charts, or the banks don't do this or don't do that, so we've got to follow suit. Like, how do you fight that? Because some people are thinking that right now.
Well, you know, do you want to go against the head? Do you want to play with the hedge funds, or do you want to be, you know, do you want to be contrarian to them? Do you want to try and compete with all of that expertise and money that they've got? I certainly don't. I kind of want to be like I don't exist in the market, because I'm doing something so far left field to what they might be doing that it doesn't affect me.
Exactly. Yeah. So you're not competing against the hedge funds. If as a retail forex trader, what you are doing is you are competing against the retail forex traders, and you know very well that the brokers are doing a great job at pulling people into this game who have no idea what they're doing. So all you have to do is be able to find money from those folks, right? I mean, that's really what it comes down to. So you're not competing against Goldman Sachs. You're not competing against Bank of America or Credit Suisse or UBS or what have you. What you are doing is you are competing against those other retail traders who are in this alternate universe. I hate to say it's not that difficult, but it's a different world, and you don't have to emulate those people who are spending $3 million to figure out what the how chaos theory can be applied to the 30-tick Euro chart. Like that doesn't even, you don't even have to go there. So yeah, I find it funny when I hear traders say these things that, oh, well, the hedge funds do this or the banks do that, you know, and that the assumption, of course, is that I must do that because these are the people that are making the money, so I've got to do what they're doing. Well, that's not true, right? That's not true. There was a guy. This is actually a funny story. There was a guy in Los Angeles, and this is, I think, back in the 70s, and so he lived next door to all of these movie stars and directors in this big giant house right on the beach. It wasn't actually in Malibu, but it was near Malibu. And so what was interesting was what he did for a living. And so all these other people were in the entertainment industry or whatever, and they were making their money by basically through movies. And so this guy, do you know what he did, Darren? Do you know how he made his money?
No.
And, okay. All right, drum roll. Drum roll. Basically, this guy would buy things and he would sell them. So he would, and what he would normally do is he would like write a letter to someone and go, look, I know you're selling your car or whatever it is, you're trying to sell it for $20,000, but I've only got 16. And he would actually send them a check and go, here, if you want, you can have this, and I'd be happy to, do the deal with you or whatever. And he even, at one point, he even bought like a used tank from the army. He was buying all these things that nobody else, but he would always buy them at a discount, and that was his thing. And so there's a principle that he was using there when he gives you the money and said, because you actually have to send the check back. This is back when people were using checks, but you'd have to send the check back to him and say no. And he knew that was a really difficult thing for people to do, because that's related to our cognitive bias called hyperbolic discounting, which is basically you don't want to give up what you have now for something possibly more in the future. You just want to keep that. And so he was operating on that. So all he was doing was buying stuff cheap and selling it more expensive, whatever he could get his hands on, and he built up his little empire that way. So I find it fascinating that, it's kind of the same thing that you're talking about. We're doing something completely different to what the others are doing on the block. All these funds and all these banks are operating in a totally different way, whereas this guy was doing something completely different, but he still had the same house that all the movie stars had.
Yeah, and he was a really smart guy, because he was he was thinking out the box, and he was thinking of the psychology really of the people who were were selling the items. And probably would have made he was a great trader, wasn't he?
Yeah, he was essentially a trader, although he probably didn't think of himself that way, but that's exactly what he was. Yes.
Yeah, and that's probably the way that we as forex traders should think of ourselves. Maybe that is the problem. We see ourselves as retail forex traders, and we read the Retail Forex Trader book, and we think that that's what we have to do to be retail forex traders. And actually what you need to do is you kind of need to read the book and say, oh yeah, well, there's some interesting stuff in there. How am I going to find an edge knowing that's what everybody else is doing? And if you follow what everybody else is doing, then you're going to find it very hard to have an edge, and moreover, I suppose that's easier for bigger accounts to exploit if they know what the majority of people are doing. So you kind of have to read the book, but not necessarily follow it. You need to find that edge.
Yeah, so thinking about, when you take a trade, thinking about what the people on the other side of the trade are thinking, I think that's a really useful thing. So you go, okay, I'm going to buy here. So looking at this chart and thinking about, where are the losers here? Like, if I'm right, if this is going to be a winner, what are the other people thinking? And so I find that kind of a useful way. The other really cool thing to do is to just flip the chart. So some of us have sell biases or buy biases. If you can flip the chart around and see it from a different point of view, that's another one that can work. But yeah.
Well, and the thing is, you're going to be told when you're doing something a bit left field, because whenever I take an entry, whenever I take a trade, it feels slightly uncomfortable, because if it felt perfect to me, then I'm starting to question why it feels perfect, and it's probably for the wrong reasons. And for me, if something feels uncomfortable in trading, it's usually because I'm making a good decision, like holding on to a trade perhaps where it feels uncomfortable to hold on to it longer. That's usually because that's what you should be doing. It's because the trade's going in your direction and there's a lot of profit there and you should make the most of it. But that feels uncomfortable, and so your body is going to tell you when you're doing these things, and it's likely to be an uncomfortable feeling.
Yeah, and that's what they told the turtles. They said when it comes down, you can only take one trade. Take the one that's least comfortable, because we're not really geared up for finding the right spot to take a trade in the markets. We usually get it all wrong. All right, so Darren, are there any kind of closing thoughts here? So I know we've kind of meandered around here, but are there any sort of thoughts that you want to leave us with?
Well, the initial topic was whether you should capitalize on a good run, and I think really the answer is as often down to the individual and how you trade. And for me personally, I think that I should stay just consistent in my trading, because my urge to kind of ramp things up is most likely a bit of greed and ego.
Right. Yeah. And I would say, yeah, if you've got a really great win streak, it's probably more likely that you should be pulling back more than anything. But if you like this idea of really capitalizing on a hot streak, the way to do it, I think, is by the trade. So if you've got a really good trade, adding to a winner, which seems completely uncomfortable to most traders, that's the way to do it. Most traders are more comfortable adding to a loser. But that's another story. we could probably talk about that in a different episode. But that's, to me, that's the it's crazy, but that's the way we think generally, is that if we've got this really great idea for a trade and the market goes against us, well, we'll just add some more, because now it's an even better price for us to take that trade, right? So to me, that's the way to capitalize on a lucky streak or a great win, is to just add more to your winner. But that's how I see it. Thanks for your time, Darren.
Cheers, Walter. I'll see you next time.